Good morning. I'm talking to John McLaughlin, who's the President and CEO of PDL BioPharma. John, can we start off by hearing a bit about the business as a whole from you?
So we're a source of alternative financing. We do debt structures, we do royalty structures, and we do some combination of the two. This is important for companies where they're looking for some financing, but they're looking for non-dilutive capital, and typically our transactions are non-dilutive. They don't have to issue equity. And that's important to companies if they think, for example, their share price is lower than where it might be, particularly if they're getting near commercialization. They want a little extra money to prepare for commercialization. So our client base, sometimes they'll do a royalty, sometimes they'll do a debt, but typically they're sensitive to the dilution of issuing equity.
Is the royalty business very competitive, and how do you go about competing with other companies that might have deeper pockets?
Sure. So like many businesses, it stratifies by size in both the royalty and the debt markets. If you're doing deals that are sort of in the $20–25 million or below, it's Darwinian. It's ruthless in there. Notice most of our transactions, they're not in that category. So typically for our royalty deals, they're someplace between $50, $60, $75 million, upwards of $240 million. That tends to be not terribly competitive. There's a few players in there. The debt deals, they typically are someplace in kind of the 50 to call it 75, $100 million. And again, that tends to be a little less competitive. It's the deep pockets really only count when you get sort of north of kind of, say, $250 million. But for most of the transactions we're talking about, we've written the checks ourselves. The biggest one we've done is $240. We do want to do some of the bigger ones. We'll probably wind up partnering with somebody, but that has less to do with deep pockets and more just we don't want the concentration in a single asset of that much money. So it is a little competitive, but it really stratifies by the size of the transaction, and where we tend to play, frankly, it's not as competitive. I think the other thing that helps us a lot is there are shops who do royalty deals, there are shops who do debt deals. We're one-stop shopping. We offer both, and oftentimes when we're talking with a potential client, we'll give them a term sheet both for a royalty structure and a debt structure so they can sort of see what the alternatives are. And sometimes we'll offer them counsel, given their business operations, why one or the other might be advantageous for them. So that's a nice advantage in terms of being able to customize it towards what they need.
And what's particularly interesting now about the PDL story? Are there any special stock catalysts we should look out for over the next year?
So there are. Obviously, we've been doing a lot of deals. We crossed the $1 billion threshold just in August of this year. There's one that there hasn't been a great deal of focus on, and that's we actually have a royalty due on an antibody called solanezumab. So it's being developed by Eli Lilly for the treatment of Alzheimer's disease. And sad to say for the patients, most of these therapies haven't worked. But there is some interesting data on this one. And there's some interesting data on one being generated by a Biogen. They have similar mechanisms of actions. So we're seeing some provocative data. Lilly did an earlier trial where they saw a benefit in mild patients with Alzheimer's, but not the moderate patients. They're doing another phase 3. That trial is fully enrolled, and it's expected to report data next fourth quarter of 2016. Why it's important for us is we have a 2% know-how royalty on that. So what that means is from when it's first commercialized, first sold, for 12.5 years thereafter, we get a royalty of 2%. If you look at some of the analyst estimates, I think they're becoming more bold, both in terms of is it more likely than not to be a good data set. You're seeing that now. They're also suggesting even with a mild patient population, the range of forecasts is a low of about $4 billion a year, and the high is about $9 billion, and most of them are clustering sort of in the $7, $8, $9 billion range. So you multiply 2% times that, and that's real money for PDL that we could both pay out to our shareholders and also invest in new income generating assets.
And how about challenges you might face over the next few years?
So I would say the biggest challenge we faced is shutting down. So the biggest challenge we faced has been sort of the equity markets. I mean, for a period of time, the equity markets were open, but you didn't see an appreciation in share prices. In the last 12 months, you had both, and that's a That's a difficult environment for people who offer alternative sources of financing. So now we're seeing, in fact, share prices are down, and while the equity markets are open for healthcare, they're certainly not nearly as robust or open as they were previously. So probably our biggest challenge is the one from the last 12 months, which, sad to say for the rest of the industry, may be disappearing for us. And frankly, we're feeling pretty optimistic about the next 12 months.
Could you summarize for us your financial and operational outlook for the current year?
Sure. So our goal for this year, both last year and this year, was to deploy in excess of $400 million. We beat that dramatically. We're over $500 million at this point. We were trying to do between $200 and $250 million this year. So far, we're at about $200 million, a little bit over that. We'll see how it goes for the rest of the year. So we're seeing very nice transactions, even in the face of that wide open equity market that's a competitor to us. So I think we'll hit our goals. Next year we'll probably have similar goals in terms of deals. We think we're on track to hit the milestones we made public. We're feeling pretty good about them.